My co-host this morning is John Johnston. He's Executive Vice President and Chief Strategist at Davis Ray. We want to talk, John, about opportunities that you may see in stock markets outside of the country. A lot has been made this year about the strength of the U.S. consumer. It's thought to be a driver of U.S. markets. You think the global consumer also in pretty good shape?
Well, yeah. I think there's two stories here. One is the U.S. consumer has been out to the woodshed and has been beaten up, and now their finances are much improved. And I think they're in the early stages of a fairly long recovery. I think they're behaving differently than they did prior to the crisis. The saving rate, they seem to be saving about 5% of their after-tax income. They're borrowing in line with the growth in their after-tax income. So it's going to be income growth that generates the consumer spending, but I think it's there for a marathon as opposed to a sprint. We're going to get some housing data, but in a little while. But you know, the housing market is recovering. A lot of it's in multiples units for rentals, but the single-family segment's coming back, and over time, you know, it looks like housing is going to keep pushing forward. So I like the U.S. consumer for a long-term recovery. And I think the global story is very strong as well. The story about the emerging markets has been well known for some time. You're moving millions and millions and millions of people from subsistence towards middle-class lifestyles. It's been interrupted by some tougher times in the emerging markets in the last number of months, and I think that could extend into 2016. I'm worried it's going to extend into 2016. But I think as a kind of a secular theme, I like the global consumer, the U.S. consumer. We're all aging. I think that's a story for the ages as well, so it's another secular theme. So it leads into healthcare. And also, we need more labor saving and labor assisting capital investment in technology, so information technology and the industrials. So those are, I see a much bigger menu of those outside of Canada, particularly in the United States. Right. I'm very negative on the Canadian dollar in the long run. A few years ago, I came out and said 70 cents. I think that was too optimistic. Wow. I'm thinking now that that was a 10-year target 2.5 years ago. We got here a lot quicker than I thought. My new long-term target, which is now 7 to 7.5 years, is 55 cents. I think we have to undershoot the old low to stimulate enough export activity.
Okay, we promised earlier on that we'd get John Johnston to flesh out his thoughts on the Canadian dollar. That's after he told us his longer-term call on the loonie is 55 cents U.S. What takes us to 55 cents U.S.?
Well, I think the most important thing for me for the long-term trends in the Canadian dollar has to do with the commodity cycle. And John Kim alluded earlier that he thinks the super cycle in commodities is over. I certainly agree with that. And that says that we're in a secular bear market for commodity prices relative to other things, relative to equity prices and stuff. And we're in a secular bear market for the Canadian dollar. And, you know, I put out a call, I guess, in early 2013 that I thought we'd get to 70 cents, and that was considered to be pretty dramatic back then, and I'm stunned that we've gotten this close this quickly. But a couple things have happened in the interim. My view on commodity prices and the super cycle hasn't changed. What we have seen is when I made that call initially, the U.S. dollar was still in the process of making a bottom. We hadn't started the secular uptrend in the U.S. dollar. And also, I think it's become more apparent since that I made that call that Canada's export base has been hollowed out worse than I thought. And I think that we're going to need to see the Canadian dollar undershoot its historic low of 62 cents to really stimulate it. We need to be competitive with Mexico. We've lost a lot of investment in the auto sector to Mexico. So I think Canada has a lot of adjusting to do, and I think the currency is going to need to be a cushion for that. And the U.S. dollar is in the early stages of a multi-year run. We talk about the U.S. dollar surging, but what the U.S. dollar is doing is very consistent with what we've seen in past cycles. The rate of increase in the U.S. dollar will slow down, and you know, I don't think we're going to 55 cents immediately. And I agree with what Adam Butler said, that the next 3 to 5 cent move in the Canadian dollar is up, and that may be the last chance we get to buy U.S. dollars at 80 cents or better for a number of years. And Andrew said a couple times that you know, there are people in the market who have never seen the Fed raise rates. The cycles in commodity markets are really long, and I always used to like to say that those cycles are longer than a lot of people's careers. I remember working at RBC in the mid-90s where no one had ever traded a stronger U.S. dollar. And in the early 2000s, no one had ever traded really for any length of time a stronger Canadian dollar. So when currency cycles turn, they turn and they go a long way. The Canadian dollar is turned down, and it's going to go a long way, even if there's ups and downs along the way. So my sense is that I want to be outside of Canada in terms of assets, and use any bounce in the Canadian dollar to buy U.S. dollars.
And lastly and briefly, how long do you think it will take to get to 55?
I gave a 10-year call on 70 cents, so this is 2.5 years into it, so it's a 7.5-year call, so 7.5 years today.
Okay, great conversation. Thank you very much, by the way, for being here for the full
My pleasure.